You thought the housing market was chaotic before? Just wait. Right now, over 2 million vacation rentals, yes, million, are poised to flood the market. We're talking about homes that were once lucrative Airbnbs, now caught in a tightening web of city crackdowns, tax hikes, and shrinking profits. If you're a homeowner, a renter, or thinking of investing in real estate, this isn't just background noise. This is the kind of shift that can change property values, rent prices, and your next big financial decision. Cities like Montreal, New York, and even entire countries like Croatia are slamming the brakes on short-term rentals. Why? Because local families can't compete with tourists and investors anymore, and governments are stepping in. By the end of this video, you'll know what's driving this Airbnb exodus, what it means for housing prices, and whether it's finally your chance to buy or time to cash out. But let me ask you right now, has Airbnb made housing better or worse where you live? Comment below and let's see how different this looks across cities and states. To really get what's happening now, we've got to rewind a bit. After the 2008 housing crash, people were looking for new ways to survive financially. That's when Airbnb came along, offering homeowners the chance to turn a spare bedroom or an empty property into serious cash. What started as a side hustle exploded into a global phenomenon. By 2019, Airbnb wasn't just for the occasional tourist. It had become a full-blown business model. Then came COVID. Travel froze, cities locked down. But once restrictions lifted, demand came roaring back. People wanted out, but safely. Hotels felt risky, but a private home with a backyard, perfect. That triggered the revenge travel wave, and short-term rentals were back stronger than ever. Investors jumped in fast. In 2021 and 2022, Airbnb investing was the hottest trend online. TikTok was filled with hosts bragging about five-figure months. Real estate YouTubers were teaching how to scale to 10 properties in 12 months. And in many cities, short-term rentals were pulling in double or even triple the income of a long-term lease. By 2023, the US had 1.4 million active STR listings. Globally, over 7 million. But here's the catch. When everyone's chasing the same strategy, margins shrink fast. In tourist cities, the market got flooded. Guests had endless options, hosts had to drop prices, occupancy rates tanked. What felt like easy money quickly turned into a daily hustle just to stay booked. Because this oversupply isn't just a numbers game anymore, it's the start of a major shift. And it might be coming to your zip code next. It's not just the market that's turning, governments are too. Cities around the world have decided they've had enough. Why? Because short-term rentals, once seen as harmless side hustles, are now being blamed for housing shortages, skyrocketing rents, and hollowed-out neighborhoods where locals can't afford to live. Take Montreal, for example. The city has started limiting Airbnbs to just the summer months. No year-round listings unless you're a hotel or a licensed bed and breakfast. It's a move designed to give locals back their housing stock. In New York City, Local Law 18 took effect in 2023, making it nearly impossible for hosts to rent out entire apartments for fewer than 30 days unless they're present during the stay. Airbnb called it a de facto ban. Meanwhile, in the UK, Cornwall Council just approved a 100% tax premium on second homes. That's right, double the taxes if your property sits empty most of the year. And Croatia, one of Europe's top tourist destinations, is preparing national-level regulations to rein in STRs and cool down housing inflation. And it's not just policy, it's economics. More listings mean more competition. In cities like Austin, Nashville, and Phoenix, Airbnb revenues are down by 30 to 50% year over year. Hosts are lowering nightly rates just to stay booked. And even then, many are struggling to break even after mortgage, cleaning, and platform fees. This oversaturation is a red flag for investors. The Airbnb boom created a feedback loop. High returns led to more listings, which led to lower returns, which led to panic. And guess what? We're starting to see listings vanish. Thousands of hosts are delisting their properties or pivoting to long-term tenants. Some are cutting their losses and selling outright. In short, the Airbnb party is ending and the hangover is setting in. Governments are regulating harder, profits are shrinking, and homes that were once STR gold mines are about to hit the open market. The flood isn't coming, it's already started. If you were in charge, would you crack down harder on Airbnbs or let the market sort itself out? Tell me in the comments and like this video. Your take might surprise someone watching from the other side of the country. Let's be real. Many Airbnb hosts didn't just own one property, they built portfolios. Some took out HELOCs, others used DSCR loans based on rental income, not personal income, all chasing that promise of Airbnb riches. Now, that promise is unraveling. In places like Arizona, Florida, and California, thousands of STR owners are underwater. Why? Because their math no longer works. Mortgage rates shot up, booking rates dropped, and new regulations have them facing restrictions, fees, and fines they never expected. Take the Mornington Peninsula in Victoria, Australia, a vacation hotspot. In early 2024, it saw one of the biggest holiday home sell-offs in its history. Hundreds of properties hit the market within weeks, many of them former vacation rentals. Locals say it's creating ripple effects from falling home prices to a surge in long-term rental availability. In the US, similar signs are emerging. In Nashville, Airbnb arbitrage operators, people who lease properties and re-rent them short-term, are shutting down. Some are breaking leases, others are negotiating with landlords to convert to long-term tenants. Even seasoned investors are tapping out. Facebook groups and Reddit threads are filled with hosts looking to offload STRs they bought at the peak. Many of these homes were bought with optimistic projections, assuming 70 to 80% occupancy year-round. Now, some are lucky to get 30 to 40%, and when one investor sells, it doesn't just affect their wallet. It affects comps, it affects appraisals, it affects entire neighborhoods. The short-term rental wave gave investors a huge edge in the housing market for nearly a decade, but the tide is turning, and fast. Now, many are left asking, do I wait it out or sell before prices drop further? So, what happens when 2 million vacation rentals globally start pouring back into the housing market? In short, ripple effects everywhere. Let's start with home buyers. In red-hot vacation destinations like Sedona, Scottsdale, and Palm Springs, locals have been priced out for years. Homes that used to sell for $400,000 shot up to $700,000 because investors were bidding with Airbnb projections, not real incomes. But now that STR profits are drying up, those same investors are selling. That means more inventory, fewer bidding wars, and, yes, price corrections. Take Phoenix. A recent Redfin report showed a growing number of short-term rental properties switching to long-term listings or hitting the MLS altogether. Some are sitting, others are slashing prices. It's not a crash, but it's a softening, and that gives local buyers leverage they haven't had in years. For renters, it's also big news. Thousands of STR properties are now becoming long-term rentals again. In places like Orlando and Las Vegas, average rents are starting to stabilize or even drop slightly as more supply re-enters the market. For tenants who've been battling 20% annual rent hikes, this shift could offer long overdue relief. But here's the twist. It's not all good news. If too many STRs flood the market at once, it could overwhelm local real estate markets, especially in smaller cities. Prices could fall faster than expected, leaving some homeowners underwater. And if investors panic sell at scale, it might even trigger a localized housing correction. Then there's the economic factor. Short-term rentals fueled local economies, cleaning crews, property managers, landscapers. As bookings disappear, so do jobs. That's especially true in tourist towns where STRs made up 20% or more of all housing stock. We're also going to see a reshuffling of who can afford to own. Investors who once dominated the market may retreat, making space for first-time buyers, but only if mortgage rates cooperate. Bottom line, the Airbnb unwind could rebalance the housing market, but it won't be painless. The Airbnb gold rush is fading, and fast. What began as a clever way to earn extra income has exploded into a global reckoning. Cities are tightening regulations, investors are bailing, and up to 2 million vacation rentals could soon return to the market. For renters, that might mean relief. For buyers, it could unlock long-awaited opportunities. But for investors and homeowners who went all in on the Airbnb dream, the timing couldn't be worse. This isn't just a story about vacation homes, it's about how we use housing as shelter, as income, as investment, and what happens when the balance tips too far in one direction. The big question now is, are we witnessing the collapse of a bubble or just the end of a cycle? If you're a buyer, this could be your moment, especially in markets where inventory is rising and prices are softening. But act wisely. The smart move isn't just to buy. It's to run the numbers, check the local rules, and understand the shifting dynamics of supply and demand. If you're a host or investor, reevaluate. Can your property survive new taxes, lower bookings, and tighter laws? If not, it might be time to pivot or exit. The Airbnb era isn't over, but the rules are changing fast, and those who adapt first will come out on top. Do you think this is a housing market correction or the start of something bigger? Comment below, and don't miss my next video, so like and subscribe to keep updated.